We have Dylan Leclair joining us now live. How are you, buddy?
Doing good. I like the past segment about the Dow hack. That's interesting.
What do you think about it?
Can you guys stop trading? Yeah, I mean, it's. I think everybody should go at least read about it, learn about it. It's an important part of crypto history, and I think there's a lot of lessons there. So it's interesting to see kind of the transparency of these blockchains and the hacks and all of that happens, and the narrative that Bitcoin crypto is for criminals, when a lot of this stuff happens completely transparent and law enforcement cracks down. It seems a little bit counterintuitive to a lot of narratives. So that's, I guess, my basic thoughts.
Yeah, when you think about kind of the chain splits, the hard forks, obviously the your reference there to I think it was Vitalik saying like, hey, can you guys stop trading? Obviously there's things like developers do something over the history of Bitcoin and cryptocurrencies that has become kind of funny memes. What's your general sense of like the Bitcoin perspective on like never changing? And kind of remaining rigid, and whatever happens, but the chain stays the chain, versus some of these other approaches like around the DAO hack and the hard fork. Like, do you think that it's important that Bitcoin has stayed rigid, or are there times where it would have been beneficial to have actually pursued a similar strategy?
Yeah, I mean, I think that's just the difference between Bitcoin and a lot of the crypto ecosystem, and that's okay. Bitcoin has just this immutable chain of property rights, and it's going to TikTok next block. You can't do anything about it. A block will be mined, in the next 10 minutes or whenever it does, and no one anywhere in the world can do anything to stop that. Whereas with Ethereum or Solana, there's times where the chain stops altogether because they need to fix something, and that's okay. It's just that when you're talking about money, global decentralized money for the world to use versus a smart contracts chain or platform, there's obviously a lot of differences there, and that's okay. I mean, that's where the debate comes in. But when you try to compare the two or claim something is ultrasound money, or that they're even competing at all, even though because of the crypto market liquidity, a lot of times when Bitcoin's up, a lot of altcoins chains are also the ticker symbol is up, or when Bitcoin's down, the whole market's down. I think it's just, the conversation or the debate, I guess, if you want to call it, should just be shifted entirely, because they're not really competing for the same market, despite what a lot of people think.
Yeah, I think that's a very, very fair way to look at it. Let's get into some of the charts that you've got for us today. You've got the USDC and USDT circulating supply. So this is Circle's stablecoin, and then Tether. The numbers just keep going up and to the right, man. It's pretty impressive to see how fast this stuff's growing. Why is this important?
Yeah, so the past couple of weeks we talked about equity market correlations. We looked at on-chain stuff. We looked at derivative stuff. So today I thought I'd just throw together some stuff about kind of the stablecoin market and how that's blossoming, just to cover something a little bit different, but an important part of this entire ecosystem. So Circle, Tether, the two leading stablecoin issuers, we see rumblings of CBDC talks, whether that's Congress or the Fed governor saying, hey, we need a central bank digital currency. We're seeing what's happening in Canada with that aggressive overreach by government on people's bank accounts and financial services. So all of this stuff is going to be heavily debated over the coming years. And so do you want to hold something like a stable coin that can be like choke point by some central issuer? I think a lot of people are going to come to realize that their money isn't actually their money. So stable coins, they're actually serving a pretty big purpose in the world, in this ecosystem. And no, it's not immutable decentralized money like say Bitcoin is. That's censorship resistant, seizure resistant. But what it does do is it allows dollars to kind of flow freely on crypto rails. So this next chart, the circulating supply here is about 120 billion year over year. The growth is like 200%. It was about $40 billion combined a year ago today. And so over the last year, these two stablecoins have done like $2 trillion of transfer volume each, which is like an order of magnitude, a couple orders of magnitude more than their actual market cap. So that they're actually like the circulation rate or how fast these things are changing hands is actually remarkable when you're thinking about this versus say dollars in the banking system. And so for the longest time, the crypto market didn't even have any stable coins. It's just like Bitcoin was your kind of your safe haven. And when these kind of local bubbles pop, you had nowhere to really run. And the on and off ramps were really, really tricky to use. So now people, and you can debate, how safe some stable coins are, or if their reserves are backed or not. And that's an entirely different discussion. But a lot of these stable coins, and I think, increasingly so, will just hold treasuries. And essentially they're just like, US dollars treasuries that can be changed hands in crypto markets in, a couple seconds around the world. And so in terms of innovation, I don't know how it's just, another kind of database entry on a centralized ledger, and that's fine, but it's a lot better than, say the legacy banking system and integration with the crypto markets today.
So when you look at these stablecoin, like we looked at both the circulating supply and the annual transfer volume, is it your thought process that just more and more the financial system is going to move over because these are superior rails to other dollar rails, and people who want that stable value, as long as they can get comfortable with any perceived or real risks of what's backing it, auditing it, et cetera. Once they get comfortable with that, just the entire financial system will flow over into stables.
Yeah. So, I mean, how I think about it is, and I focus on Bitcoin, with almost all my time, because I think it fixes or addresses one of the biggest problems in the world today. There's a $300-400 trillion problem. And we've talked about that. It's a broken cost of capital, right? So if you have money in the bank account, you deposit with the bank, they actually lend your money out for you fractionally. They fractionally reserve your deposit and lend it out to other debtors. But you don't get any of that yield. You don't get any of that upside, even though they're lending it out on your behalf. So that 0% yield you get in a 7% inflationary environment, you're not doing too well. But with, say, stable coins, or in this kind of emerging crypto Bitcoin ecosystem, what you can do is you actually lend peer to peer. So say on FTX, a centralized exchange, you can lend your dollars to someone else that's using margin. Or on, say, a DeFi protocol, right? You're putting stable coins into a liquidity pool, and right there's a debate about what's the custodial risk? What's the platform risk on a lot of these protocols? Are they going to get hacked? Are there exploits? And that's something that people are finding out in real time. Like it's not risk-free in the sense that, nobody, there's not the FDIC going to back you if you get hacked, right? But what you can do is you can lend your stables out, or you can borrow dollars at a really a market rate, right? So sometimes that market rate in this ecosystem is 5%, sometimes it's 20%, but these markets are free and open, and these stable coins allow basically, creditors, debtors, people that want to collateralize their assets and borrow or lend to someone else, to do that at a rate that's decided by the market, and not 12 guys sitting in a room saying the Fed's fund rate is going to be 0% again. And so I think that's the exciting thing about what's happening with, kind of dollars on crypto rails.
Yeah, it's wild that there's 12 people who make that decision, but that is the world that we live in today. You've got this chart on stablecoin supply ratio. Explain what you're looking at here.
Yeah, so this is just over the last couple of years as stablecoins have become a bigger and bigger part of the market. This is the stablecoin supply ratio is basically the Bitcoin market cap divided by the stablecoin market cap. So right now, I just included USDT and USDC because they're the two biggest, but there's other stablecoins out there. There's some kind of algorithmic stablecoins. So like they're collateralized with other assets and they're not actually backed by dollars in a bank account. There's all sorts of things, but basically this is the aggregate stablecoin market cap as a percentage of the Bitcoin market cap. And what you can see is with this ratio falling, the buying power of this dry powder in the market relative to the Bitcoin market continues to get larger and larger. And so I have these kind of Bollinger Bands on this supply ratio, and when it gets to the upper band, it's basically that the Bitcoin market cap is really big compared to the size of like the dry powder on the sidelines, stable coins. And when it hits that kind of lower threshold, it's showing the opposite. It's saying that dry powder is a pretty significant portion of this Bitcoin market cap. And so we're on one of those lower bands. All that's showing, and we're honestly at like a near historic low in this supply ratio. So it's showing that the stablecoin dry powder on the sidelines, 120 billion plus relative to the Bitcoin market cap is pretty substantial. And so there's a lot of people on the sidelines waiting to buy the dip.
Yeah, that's probably going to be a good decision if we look at the historical perspective and what usually plays out. You've got Bitcoin futures open interest. Why is this important?
Yeah, so this is the stablecoin margin open interest, right? So with Bitcoin futures, you're entering a contract, and that contract's marked to market every second, and you can enter that contract with various sorts of collateral. And traditionally, when these derivative markets first were spun up, you were actually collateralized. If you were long Bitcoin, you were collateralizing that contract with Bitcoin or with another crypto asset, but mainly Bitcoin. And I guess sometimes you can do it with ETH, but traditionally it's Bitcoin as collateral in these markets. And so now increasingly so what you're seeing is stable coins as basically collateral in these derivative markets are becoming more and more prevalent. And so that actually is pretty good in terms of risk profile for bulls, because when there's these downturns, these big market crashes, and you're long Bitcoin with Bitcoin as collateral, it gets pretty ugly, and that unwind is somewhat reflexive. Your collateral is going down in value, your profit, your P&L is going down. And so it basically forces people to sell. It's these cascading liquidations that you see. And so stable coins as collateral and kind of entering these derivative markets really is advantageous for these traders. And I think that's why you're seeing it become more and more prevalent over the last couple of years.
All right. And then when we look at Bitcoin percent futures open interest crypto margin, this is kind of another variation of a similar thing.
Yeah, so this is just the percentage of that. So with this chart declining over time, right now about 42% of the market is crypto margin. So if you can think of the inverse, 58% of this market is the futures open interest in Bitcoin, which is a $10 billion plus market. And on the futures open interest, I quoted it in Bitcoin terms. So it kind of it evens out that volatility, but 58% is stablecoin margin, and compared to say 30% at the top of the market. So in the top in April, you had basically 70% of the derivatives market. They were taking their Bitcoin and they were longing Bitcoin with Bitcoin as collateral, right? So that's obviously not very sustainable, and we're seeing that trend actually reverse big time. And so much more healthy state of the derivatives market, and I expect that trend to continue into the future.
Got it. And then when you look at this 3-month annualized rolling basis of Bitcoin futures, what are you seeing there? Seems just kind of just going down since about November.
Yeah, so we talked about this one of our episodes, the podcast episodes we did, where we talked about Bitcoin as a solution to the broken cost of capital, and we talked about how Bitcoin's a bearer asset, but the markets around Bitcoin kind of are entrenching themselves as this new form of, or like almost risk-free cost of capital. So this futures rolling basis, what you can do is you can sell futures and you can long the spot. And oftentimes, or most all the time, the futures, the front 1 month or 3-month futures is trading ahead of that spot market price. And so right now with this metric at about 5%, you can capture about a 5% annualized yield by just selling the 3-month forward futures, longing spot, and you're market neutral, but you're collecting that yield. And so during times where the market's very speculative, bulls are very speculative, say in November of 2021, this was about at 20%. So you could capture a 20% annualized yield. At the top of the market in about April, you could get about a 45% annualized return. And so this just kind of shows that speculative nature of the market. But increasingly, you see institutions coming in that really are market neutral. They're taking no upside or downside risk in Bitcoin, but they're collecting this annualized return. And so this kind of basis, this risk-free yield, if you want to call it, it's all throughout the crypto Bitcoin ecosystem, whether it's futures, whether it's perpetual futures, whether it's DeFi protocols or yields. Basically, there's kind of this new cost of capital that's completely like contrary to the Wall Street walled garden legacy system, where junk bonds are yielding you 5% before inflation, before default risk. It's almost like there's this new parallel system where people are saying, nope, this is actually the real cost of capital, and I'm not parting with my money for a negative yield.
John, what questions you got?
Dylan, how do you think about the different stablecoins and evaluating them? So if you want to put money into the stablecoin market and kind of collect those yields that a lot of companies offer, what do you choose between like USDC, USDT, Gemini, USD? Like, how do you think about that?
Yeah, so I mean, I think a lot of the tethered truthers have been not proven wrong, but there's definitely some questionable things in the past about whether they're fully backed and the things that Bitfinex and Tether did. And there's a whole kind of rabbit hole you can go down with that about were they fully backed throughout time. But I think the recent audits looked good. But I think the biggest thing is I would say probably USDC is the strongest in terms of like the regulatory environment and having a proof of reserves. But if you are, say, a Tether truther and say that Tether is fraud, if you really believe that, well, there's a simple thing you can do. You can simply go into the market, you can borrow Tether, and you can buy USDC, you can buy Bitcoin, you can buy any asset. And if Tether turns out to be fraud, well, congrats, you shorted it. So I think a lot of it is more so talk, when in reality, if you have this strong thesis, if you really believe that, some of these stable coins are fraudulent or not, well, go out and short it, because there's huge markets with billions of dollars to do this very thing.
Dylan, when you start to look at a lot of what's going on in Canada, obviously the Russia-Ukraine stuff, I've seen a number of headlines that are like, oh, people are selling their Bitcoin because Russia's going to invade Ukraine, or, oh, people are buying Bitcoin because of what's happening in Canada. One, like, how do you evaluate what of that is true and what is not? And also, two, is do you think that the geopolitical movements globally have that much impact on Bitcoin buying and selling, market price, et cetera?
Yeah, so I think the Canadian kind of thing is somewhat not unprecedented, but if you would have said a liberal democracy, first world country, our friendly neighbors up north would kind of turn to authoritarianism rather quickly, where anyone that is peacefully opposing the kind of political party in power would have their bank accounts frozen, assets potentially seized, credit cards turned off. I don't think a lot of people expected that. So whereas Bitcoin was kind of this digital gold narrative, speculative asset, now it's okay. Wait, the theories about censorship resistance and being your own bank, it's not a theory anymore. It's like, it's happening in practice, and we need money that can't be arbitrarily taken from us. And so I think a lot of people are waking up and saying, my money's not safe in the bank. And they just, average people that donated their money to peaceful protesters. This is not like, this isn't like they're radical extremists at all. I mean, have you seen the videos? They're just waving flags and jumping around in bouncy houses. It's like rather peaceful. And so I think a lot of people are waking up to what's happening up north in terms of, the geopolitical instability. I put out kind of a joke tweet yesterday about, a thread about my observations on Ukraine and Russia, and then said, like, I'm no expert. I have nothing to offer here. I'll leave that to other people. But, a lot of people are trading this. And if you're looking at Bitcoin and equities trading tick for tick over the last couple of weeks, I think more so that's what's happening, is that the implications of what's happening in terms of currency markets, bonds, equities, there's ripple effects into the Bitcoin markets. And so, if people are buying or selling Bitcoin because of what Putin said in his speech or not, I think that's more short-term noise. And, the bull case for Bitcoin and why we need it in the world today is never been stronger. And I think that's clear for anybody that's kind of paying attention to what's happening.
Yeah, it makes a lot of sense. The other piece too that seems to be interesting development is we're seeing more and more politicians start to get into Bitcoin, stable coins, crypto conversation in general. We've seen everything from politicians put forward legislative ideas around, hey, you will not be able to create a central bank digital currency that doesn't meet these criteria that basically preserve the benefits of cash. There's people who have put forward at the state level legal tender legislation for Bitcoin. Like, how do you think about politicians and their participation in some of this stuff now? Is it just a foregone conclusion that they're all going to have to get on board, or can some of them still fight it?
Yeah, I mean, the Overton window is shifting rapidly, right? Where it was kind of this niche thing to support Bitcoin, crypto a couple of years back, and now it seems like it's totally shifting to where if you don't support this openly, you're not going to stand a chance. And so, the midterms are going to be really exciting. We talked about it, I think, a month or two back about, how this incentive has changed pretty rapidly. So I think that's going to be a kind of a trend this midterms, and especially in the 2024, presidential elections. A lot of stuff's going to be happening. It's pretty exciting. And I think the incentives align. And this isn't just a US thing. This isn't just a state level thing. This is kind of a game theory that's playing out everywhere in the world, right? Where we see Bukele and El Salvador, they're just the first domino. And so we're going to see a lot of exciting things happen that I think are going to catch a lot of people by surprise over the coming years.
Got it. Before we let you go real quick, how are we looking on followers? Not too much growth here. I think not too much growth. What's going on? Is
you've been doing threads or what?
Yeah, is the tweeter machine broken? Oh, you're at 125. You've now hit like a nice round number there.
Yeah, not too bad. I'll pick up the tweeting this week. Who's taking a little bit of a break.
Yeah, there's a couple strategies you can employ on Twitter. You can basically say smart things, you can say dumb things, or you can say hot takes. And sometimes you could wrap all three of them in the same thread, and then you're viral. And next thing you know, you got 200,000 followers.
John, I saw you were getting ragged on for your podcast take the other day.
Yeah.
What was your podcast take?
I said to replace music with podcasts.
Not.
I
like
think people took
replace
that.
it.
I think people took that out of context. I meant like on a road trip, like at the gym.
What, did you say it?
No. That's how Twitter works. It's how you get engagement.
All right, that's fine. Speaking of music, Kanye still has not dropped his album today. People are pissed. They bought a $230 piece of hardware that looks like he put it together in his garage. I love Kanye, but people are pissed. And
I'll be at the concert tonight.
Yeah, is it a concert?
Launch party, viewership.
Like, think about this.
He's
about to fill Lone Depot Park, and people don't even know what they're going for. They're like, it's a 50-50 shot. Kanye shows up. 50-50 shot. We listen to new music. 50-50 shot. We listen to him just yell into a microphone about topics.
That's what I said.
But I'll be there.
He may not even show up.
Yeah, I mean, didn't he not show up to one of them last time?
I don't know.
Whatever. Watch the documentary. He can do whatever he wants. He's good in my book. All right, Dylan. Thank you so much for joining us. We'll do this again next Tuesday.
All right, guys.
Later, buddy.